Jai Hind everyone. Welcome to my YouTube channel, which is Explore Yourselves, Banking and General Knowledge, etc. Today I will discuss two group discussion topics related to the internal promotion examination for banks. Welcome to part 9 of my Path to the Corner Office 2025 to 2026 series, where we break down real bank promotion exam questions and give you clear practical sample answers about group discussions to help you climb the career ladder faster. Group discussions topics. First, financial literacy and its importance in India. Second, role of banks in supporting small businesses and MSMEs. Financial literacy and its importance in India. Financial literacy refers to the ability to understand and effectively use various financial skills, including personal financial management, budgeting, saving, investing, and understanding credit, insurance, and retirement planning. In India, a country with a rapidly growing economy, a large population, and increasing access to financial products, financial literacy is essential for ensuring economic empowerment, responsible financial behavior, and inclusive growth. While strides have been made in promoting financial education, a significant portion of the population, particularly in rural areas, remains financially illiterate. The lack of awareness often leads to poor financial decisions, debt traps, and underutilization of banking services. On the other hand, financial literacy empowers individuals, strengthens the banking ecosystem, and supports national development goals. Positive aspects and pros and arguments in favor of financial literacy. First, improved personal financial management. Financial literacy equips individuals with the knowledge to budget effectively, save consistently, and invest wisely. It reduces dependency on informal credit sources and helps people plan for short term and long term financial goals such as education, health emergencies, retirement, and entrepreneurship. Second, reduction in over indebtedness and financial stress. People with financial awareness are less likely to fall into high interest debt traps or engage in impulsive borrowing. Understanding credit cards, loans, and interest rates allows for informed borrowing and repayment decisions, reducing defaults and financial stress. Third, promotion of financial inclusion. India has made significant progress in expanding banking services through initiatives like Pradhan Mantri Jan Dhan Yojana and digital banking. However, financial literacy ensures that newly banked individuals actually use their services effectively. Awareness about savings, digital payments, insurance, and pension schemes enhances financial participation and reduces the unbanked population. Fourth, encouragement of savings and investment. Financially literate individuals are more likely to save and invest in formal financial instruments such as fixed deposits, mutual funds, government schemes, and insurance. This not only benefits individuals but also strengthens the capital markets and financial system by mobilizing domestic resources for productive use. Fifth, empowerment of women and marginalized communities. Financial literacy programs specifically targeted at women and marginalized groups help them gain control over their finances, make independent decisions, and participate in the economy more actively. Studies show that financially empowered women contribute to family welfare and community development. Sixth, strengthening the banking and business ecosystem. Financially literate customers understand banking products better, maintain disciplined accounts, and reduce default rates. This improves banks' operational efficiency and reduces NPAs. For businesses, better financial awareness among consumers enhances transaction efficiency, reduces fraud, and builds trust. Negative aspects and cons and arguments against challenges in promoting financial literacy. First, accessibility and reach issues. Despite government and private initiatives, financial literacy programs often fail to reach remote rural areas, tribal regions, and low income communities. Language barriers, lack of digital infrastructure, and limited awareness restrict the effectiveness of financial education. Second, limited practical application. Even when individuals receive basic financial knowledge, they may not apply it effectively due to poverty, irregular income, or socio-cultural constraints. Without disposable income, the ability to save or invest remains low, limiting the benefits of illiteracy programs. Third, information overload and complexity. The financial ecosystem is complex with numerous products, regulations, and digital tools. For first time bank users or low income individuals, the sheer volume of information can be overwhelming, leading to confusion rather than informed decision making. Risk of misinformed decisions. Financial literacy without adequate guidance may lead some individuals to take unnecessary or high risk financial decisions, such as speculative investments or loans from non reputable sources, which can be counterproductive. Fifth, slow behavioral change. Even with awareness campaigns, changing long-standing habits with reliance on cash, informal borrowing, or consumption-oriented spending is a slow process. Behavioral inertia can limit the immediate impact of financial literacy initiatives. Balanced comparison, financial literacy in India presents both immense opportunities and significant challenges. On the positive side, it empowers individuals, promotes financial inclusion, strengthens the banking system, encourages disciplined savings and investments, and supports national economic growth. Banks benefit from improved customer awareness, reduced defaults, and more efficient service delivery, while individuals enjoy better control over their finances and long term financial security. On the negative side, the benefits of financial literacy are contingent upon accessibility, relevance, and practical application. Many individuals, particularly in rural areas, still lack exposure to financial education. Low income households, despite understanding basic financial principles, may be constrained by economic limitations. Furthermore, incomplete or improperly guided financial knowledge can sometimes lead to poor decision making or high risk behavior. The effectiveness of literacy programs also depends on integrating behavioral change strategies and hands on financial experiences rather than merely providing theoretical knowledge. A balanced perspective suggests that financial literacy alone cannot solve economic inequality, or poverty. It is a critical enabler for empowering individuals, enhancing financial resilience, and ensuring the effectiveness of government and banking initiatives. Arguments for financial literacy enables better personal financial management and goal setting, reduces burden and financial stress, promotes financial inclusion and effective use of banking services, encourages savings, investments, and participation in formal financial markets, empowers women and marginalized communities, strengthens the banking sector by reducing NPAs and enhancing efficiency. Arguments against and challenges limited reach, particularly in rural and marginalized areas, poverty or irregular income limits practical application of knowledge, complexity of financial products may overwhelm users, risk of misinformed or speculative decisions without proper guidance, behavioral change is slow and requires sustained efforts. Conclusion financial literacy is cornerstone for inclusive and sustainable economic development in India. Its importance extends from individual financial empowerment to strengthening the banking and business ecosystem, promoting responsible borrowing, and fostering long term investment habits. While change challenges such as accessibility, practical constraints, and behavioral change exist, they can be mitigated through targeted programs, digital platforms, vernacular content, and continuous awareness campaigns. A balanced approach emphasizes the financial literacy is not merely about knowledge, it is about application, empowerment, and long term behavioral change. When individuals, banks, and government bodies work together to promote financial literacy, the benefits multiply improved savings and investments, reduced financial vulnerabilities, stronger banking operations, and a more financially inclusive society. In a sense, financial literacy is not just a personal asset, it is a national priority that underpins India's economic growth, stability, and equitable development. Roles of banks in supporting small businesses and MSMEs. Small businesses and micro, small, and medium enterprises (MSMEs) form the backbone of India's economy. They contribute significantly to GDP, employment generation, export promotion, and regional development. Banks play a pivotal role in supporting this sector by providing financial services, credit facilities, and advisory support. Access to finance is often the most significant constraint for MSMEs as they operate with limited capital, face cash flow challenges, and lack collateral. By facilitating loans, credit lines, working capital support, and financial guidance, banks help small businesses thrive, thereby promoting economic growth and financial inclusion. However, balancing support with risk management and ensuring sustainable growth presents both opportunities and challenges. Positive aspects and pros and arguments in favor of banks supporting MSMEs. First, provision of credit and working capital. Banks provide term loans, overdraft facilities, cash credit, and working capital support to MSMEs. These financial products help small businesses manage daily operations, purchase raw materials, upgrade technology, and expand their market presence. Access to credit ensures continuity of operations and reduces dependence on informal lending sources that may charge exorbitant interest. Second, encouragement of entrepreneurship and innovation. By providing easy access to finance, banks enable entrepreneurs to start new ventures, innovate, and explore niche markets. Financial support reduces entry barriers, allowing creative ideas to translate into viable businesses. Third, financial inclusion and formalization. Many MSMEs operate in the informal sector. When banks provide loans and financial products, these businesses are encouraged to maintain proper accounts, adopt digital payments, and formalize operations. This formalization improves transparency, enhances creditworthiness, and contributes to the national economy. Fourth, risk sharing and government schemes. Banks often act as intermediaries for government initiatives such as the Credit Guarantee Fund Trust for Micro and Small Enterprises (CGTMSE), Prime Minister's Employment Generation Program (PMEGP), and other priority sector lending schemes. By sharing risk with the government or through insurance products, banks can extend credit to businesses that may lack collateral or face high default risks. Fifth, advisory and capacity building support. Beyond loans, many banks offer training programs, financial advisory, and guidance on compliance, taxation, and digital tools. This helps small businesses, operate more efficiently, improve financial planning, and make informed investment decisions. Sixth, regional development and employment generation. By supporting MSMEs, banks contribute to local economic development. Small businesses create jobs, stimulate ancillary industries, and promote regional entrepreneurship, leading to inclusive growth. Negative aspects and cons and arguments against banks' role in MSME lending. First, high credit risk and defaults. MSMEs often have limited collateral, irregular cash flows, and vulnerability to market fluctuations. Banks face higher credit risk when lending to small businesses, which can result in NPAs and provisioning costs. Second, operational and monitoring challenges. Supporting numerous small accounts requires extensive monitoring, verification, and follow up. Banks need dedicated staff, technology, and processes, which increases operational costs and administrative burden. Third, limited scalability and profitability. Loans to MSMEs are usually smaller in size and compared to large corporate lending, resulting in lower interest income per account. The high cost of servicing multiple small accounts can affect profitability. Fourth, risk of misuse funds. Without proper oversight, some MSMEs may divert loans to purposes other than intended, leading to defaults. Banks must implement stringent monitoring, which increases compliance requirements. Fifth, dependency on government schemes. While government backed schemes reduce risk, over reliance may discourage independent business growth and or limit access to credit for MSMEs not covered under such programs. Banks may prioritize scheme backed lending, reducing flexibility. Sixth, economic vulnerability. MSMEs are highly sensitive to economic cycles, inflation, and market stocks. During downturns, banks face concentrated risk exposure in this sector, potentially affecting financial stability. Balanced comparison. Banks supporting MSMEs present a trade off between fostering growth and managing risk. On the positive side, access to banking finance strengthens small businesses, promotes entrepreneurship, facilitates financial inclusion, and contributes to economic growth and employment. Banks act as catalysts for innovation, regional development, and formalization of informal enterprises. Government backed initiatives and advisory services further enhance the effectiveness of this support. However, the negative side highlights significant risks. MSMEs are vulnerable to market fluctuations, cash flow shortages, and operational inefficiencies, which increase default risk for banks. Managing numerous small accounts requires higher administrative effort and technological investment. Profitability from MSME lending is lower compared to corporate lending, while economic downturns can disproportionately affect this segment. A balanced perspective suggests that banks must adopt a strategic approach. Risk assessment frameworks, credit scoring models, collateral substitutes, and portfolio diversification can mitigate risks while enabling credit growth. Leveraging digital platforms for loan dispersal, monitoring, and advisory services can reduce operational costs and improve scalability. Moreover, collaboration with government schemes allows banks to share risk and extend financial support to underserved businesses. Arguments for banks supporting MSMEs encourages entrepreneurship and innovation, provides critical working capital and credit facilities, promotes financial inclusion and formalization, supports regional development and employment generation, strengthens national economic growth and diversification, enables access to government backed risk sharing schemes. Arguments against and challenges: high credit risk and potential for defaults, operational burden of monitoring multiple small accounts, lower profitability per loan and scalability challenges, risk of fund diversion or misuse, dependency on government schemes may limit flexibility, vulnerability to economic cycles and market shocks. Conclusion: banks play a pivotal role in nurturing small businesses and MSMEs in India, acting as enablers of growth, innovation, and financial inclusion. By providing credit, advisory services, and access to government backed schemes, banks help micro and small enterprises overcome capital constraints, formalize operations, and expand their market presence. This, in turn, strengthens the broader economy through job creation, regional development, and increased productivity. However, supporting MSMEs is not without challenges. High credit risk, operational costs, limited profitability, and economic vulnerability require banks to implement robust risk management frameworks, use digital tools, and adopt strategic lending policies. Balancing the dual objectives of promoting credit growth and mitigating risk is essential for sustainable banking operations. In a sense, banks serve as a bridge between financial resources and entrepreneurial potential. When supported by technology, risk mitigation strategies, and policy incentives, banks can maximize the positive impact of MSME lending while minimizing associated risks. The result is a win-win scenario. Thriving small businesses contribute to economic growth, and banks achieve sustainable returns with controlled exposure. Thus, the role of banks in supporting MSMEs is both crucial and strategic for India's inclusive economic development. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.